key risks you see for the mutual fund industry over the next 5 to 10 years?
Risks to the mutual fund industry over the next 5 to 10 years. That will need a bit of decoding to get right.
Hello everyone. Welcome to part 2 of our Wealth Insight podcast, where we continue our conversation with Vishal. In our previous episode, Vishal laid the landscape of the mutual fund industry, how it is a part of your core portfolio, how passive, active investing can complement each other, and we talked about SIFs. But we left you with a cliffhanger. What is the biggest risk for the mutual fund industry? So Vishal, we left with that question. What is the biggest risk for the mutual fund industry?
Right. I think, one thing I would worry about is almost the burden of expectation that we often have, because the last 4-5 years have been so stellar in terms of the market delivering so much performance that one seems to be a bit maybe running ahead in terms of how much we expect from the markets and therefore mutual funds. So often we get into conversation where we say that, my expectation is that this mutual fund will deliver 30% growth and 25% growth or 40% growth, which is a bit scary. So I think expectations have to be a lot more grounded, and all of us together have to do a lot more in, getting this back to the fact that, look, this is not a magic pill to get rich quick. This is about creating wealth over the long term, and it has to be a bit more balanced and rational about what we are doing. Otherwise, my concern would be that if too many investors expect almost an unreal return from mutual funds, then it may end up in disappointment. So that's one area that I worry about. The second is risk in the markets, and as they say, risk is something you didn't see coming, because if you saw it coming, then we would have done something about it. But there are so many risks, including cyber risk, KYC, frauds, etc. As an investor, look, I am not expected to decipher what went wrong, but if I put in money somewhere and it didn't give me the returns, or if I was impacted by an adverse event like a fraud, I will be jolted and maybe jarred out of that investment product. So I think the ecosystem coming together to maintain and enhance the trust that we've built over the years, whether it is with operational efficiency, return, regulatory oversight, keeping things going so that money is accessible when you need it. I think these are all very important components of the ecosystem that we have to protect and nurture. So avoiding a mistake in the future, I think, is an equally large part of risk management for the industry.
No, that's a great way, Vishal, to segue into this part of 2 of our conversation, where I wanted to talk more about what are the enduring principles that you can have in building your portfolio. And I wanted to kickstart with the more fundamental question. You have had a long career across and with senior leadership roles across private banking, wealth, asset management. In your view, what is the key investment principle that an investor should follow so that he can tide through these market cycles?
Right. So look, I think I don't think there is any one investment principle, but maybe I can just talk from what I have seen or what the mistakes I have made, if I may. So one is, I think sometimes when we start investing, we really don't know what it is that we're investing for. And I find that if I anchor my goal and therefore the investment strategy to the goal, then it becomes clearer. So as an example, if you have 100 rupees to invest and you're thinking about how you should go about choosing where to invest and how to go about investing, the moment you have a goal that, let's say, this is money that I will need 3 years later, doesn't it become so much clearer that therefore how much risk I can take and where I should therefore go about doing it? And if you're using an advisor, then that's great information for the advisor to help him or her plan it for you, saying, okay, 3-year investment horizon, therefore this is what you should do. So often I find that we start investing, which is good, but without a goal. So attaching a goal to an investment pod, I think, is a good way to have the next few steps that you should consider become clearer. And that's just something I've learned over the years, that don't just start, but start with a goal in mind.
Yeah, actually it's good you brought about the goal, because what a lot of new investors, especially post-COVID, new or even seasoned investors, and you talked about return expectations, have got convinced that the market will give you 15-20% returns. They've not seen significant market drawdowns. What would your advice be to such an investor?
Right. So as they say, what goes up comes down.
Yes.
So be wary of the mean reversion that can happen. Now that shouldn't scare you. It's just a part and parcel of the market. So every market graph that you would have seen will see ups and downs. So don't get scared out of it. But having a straight line is not real. So this is going to happen. Business cycles are real. Market cycles are real. So just it's about expectations that we spoke about. So yes, the last 5 years have shown you the potential of what can happen if you continue your investment journey. If there is a flattish phase, just think about that as an equalizer, a bit of a shock absorber, which is good. It's a bit of a reality check. And if it doesn't happen, I would be more worried, frankly. So the reality check is good. But that could also be an opportunity for the next phase. So if you are in the camp that gets too scared to then, either exit the market or not do anything about that opportunity, then it's very difficult for one to, be able to generate wealth over a very long period of time. And that behavior is something we've seen diminish over the years, but it's still not gone away. So every time the market corrects and stays flat for some time, I think the past returns become a bit more disappointing for many, and then people said, oh, I'll stop investing, I'll stop my SIP, or I'll redeem, even worse, some of my investment. And that's where I think the entire journey gets less potential as just the, a tried, tested sort of long-term investment strategy would have delivered.
So Vishal, we discussed about the timeless investment principles. Now I wanted to focus a little bit on how you create a portfolio. In your view, what should an investor look when he's creating a broad diversified asset allocation?
So see, portfolio is very personal to you in a sense. Yes. It's like having a diet plan or an exercise regime. Now you can't really say that it has to be the same for everyone at one level. But there are some principles, some broad themes one can follow. So the broad themes that we generally look at is that when you're younger and you have a lot of stability in your earnings, you can afford to take more risk, because
that would mean taking more equity.
So yes, so if you can afford to take more risk, then volatile and growth-oriented assets like equity can be a larger part of your portfolio. The rule of thumbs can follow that, when you're younger, the 100 minus your age is the equity proportion, and things like that are followed. So, somewhere in the 70-80% equity can be a young person's allocation, because the remaining is for stability. And as you, grow in age and experience and wealth, the need for growth and the time horizon and your need for capital getting deployed in your later years becomes larger. So you reduce your volatility by reducing growth-oriented products and go more to income products, which is debt. So that's the sort of balance. So like with any other exercise regime and a diet plan, balance is important. What works for you is most important. And, I'm not so disciplined. So if I need to follow a good diet plan, I need a dietitian. If I need to follow a workout regime, I may need an instructor. So get yourself an advisor or someone who can help you. That I think can be actually very, very invaluable. So why try and do it alone if you can try and get ahead? Because a third-party view and an expert view can definitely add a lot of value. Keep in mind, this is the most important decision in terms of your overall financial outcome, the amount of allocation that you're taking and how you're building your portfolio. So don't underestimate how this could be the one thing that you have to get right to actually get financial freedom.
Actually, that's very interesting, because 90% studies says that 90% of your entire return is derived by asset allocation
exactly.
itself. So once you're done with your asset allocation based on risk profile and all, how do you then put in solutions? So when should you put, is equity, mutual fund the best way to play? People will say fixed income, should I put mutual fund? Should I take REIT InvITs? So how do you combine all that into making a portfolio?
Right. So look, if the allocation is clear, and let's say we're starting with an 80% equity or a 75% equity, depending on what your need for liquidity and choice is, I would say yes, equity mutual funds is a great way to start, because as a package, from a cost efficiency, from a access to liquidity, expertise, all of that, it's a great package. Now, beyond equity mutual funds, one could look at more sophisticated products, but typically that may happen later on. So in the early years, I would still think that a regular systematic investment plan topping it up when you have some extra money or extra savings, typically bonus time, or if you're a businessman, when you get some payouts, etc., is a good way to invest. Actually, I do think that product choice may not matter, like you rightly mentioned. And often we spend more time doing product choice and doing a lot of micromanagement of the fund manager and the fees and things like that. Frankly, all of that is noise. So I would say ignore it. Focus on allocation. That's where we tend to spend not enough time. And if you get the allocation right, actually much of this will not matter. But yeah, if you're coming to a fish shop, I'm going to tell you that, yes, fish is good for health, and therefore mutual funds are the best product that you can buy. More seriously, if it offers you all of what you're looking for, why are you looking beyond?
Yeah. No, that's interesting, and you mentioned the point on noise, right? Today's age, we are filled with information. How do you drown out that noise and you take structured calls on your portfolio? And what are the risk metrics that you should be wary when you're building the portfolio?
So I think, and that's a very important point, Vinay, that you're raising, because with so much information being available, it is not necessary that your investment outcome will be better. Actually, it could be worse, because as they say, analysis paralysis. So overload of information does not necessarily lead you to a better choice. It can actually disrupt, and we're seeing that some bit of that in behavior. So 20 years back, you could not access how much money you have made on your portfolio at the touch of a screen, and maybe the behavior was more long-term then than what we are seeing today, because once you start seeing returns on a day-to-day, hour-to-hour basis or whatever, the urge to take some action, do something which may be completely unnecessary, goes up. So an action bias, information overload, etc., are biases that we should not fall prey to. As they say, investment should be boring. It should be like watching paint dry or grass grow. And that becomes difficult when you are bombarded with so much information. So if there is a way to step back and build that discipline into your investment behavior, have only a periodic review of your portfolio, maybe sit down with a third party, someone that you work with on your portfolio. That, at least I find, is a better approach than watching markets every day and looking at my portfolio every day. It doesn't really add value. It may detract from what I'm trying to do in my portfolio.
No, it's great, Vishal, you mentioned this, because we also have something called as wealth principles, which acts as guardrails, which can help. I think those principles acts very well in ensuring that you build a very diversified portfolio which stands the test of times. Before we go into the fun section and end this conversation, I wanted to ask one personal question. You have had a long investing journey. What is the best financial decision you have taken in your portfolio or in your life? And what is a decision you regret not taking?
There are many mistakes, so that we can spend an hour talking about. There is no one best, but if I can maybe narrow down to one, it may be I tried things very early, and way back in college, I started investing in equity. It was small sums that you would somehow find and save, but using the power of compounding to your advantage is a lesson that you learn very quickly. That if you could invest as early as possible and forget about that investment, and suddenly you'll be really pleasantly surprised to see many years later, about that pot of money that you invested into equity and forgot, of how much that compounding and how much growth the market can deliver. I think we often just get caught in so many things that we don't do that simple thing of saying, okay, here's some investment and let me just almost forget about it for a long period of time and use compounding to my advantage. So starting early, I think, is something I may have done well. And even if it was a modest sum of capital then, it certainly didn't make me rich, but it taught me the lesson, the benefit of compounding quite early. Like I said, many mistakes, but later on in life, once you got into financial markets, you start thinking that you know more and you start doing more than necessary, and then you realize very quickly that actually more activity is not necessarily a better investment. And actually, investing is one thing where actually your qualification may work against you, not for you, because it's not necessary that because I know more about finance than my neighbor, I will be a better investor. Actually, my neighbor could be a far better investor just because she is following the principles and I'm not. I'm getting distracted. So distraction from those principles, I think, is what gets in our way. So as they say, you know, the investor does not make the return as the fund manager delivers, because our behavior gets in the way.
Yeah.
But Vinay, you're in the markets as well, so I have
Yeah.
to ask you the same thing. What has been your best decision and the biggest regret?
I think the best decision is same, that it started early, and I put it in a simple mutual fund, I believe.
Excellent.
But the regret would be that I started my career more in institutional equities. So you, as the same thing, you think you know more. So you bought certain stocks which went to zero.
Right.
And you bought some stocks where you didn't have enough position size and you sold it off. So I think selling equity very early is a big mistake, which most of us make, especially in a growth market like India.
Okay. So we made common mistakes.
Yes,
Great.
common.
Okay.
I think that's a behavior we see across investors,
Most
whether you're
investors.
seasoned or a new investor.
Right.
And I think the best example we get also is that markets teach you through cycles you learn, and you become more wise as you become.
Absolutely.
So Vishal, before we come to the end, wanted to play a little fun segment. We call it the wealth word game.
Word
So
game.
yeah. Okay. So I'll ask 4 questions, just one word, no overthinking. So we'll start.
We can try.
Okay. Wealth is?
Freedom.
Very nice. Risk means?
Opportunity.
Great. Money without purpose?
A waste of time.
A waste of time. If you had to give one advice to your 25-year-old self?
Do less. Less is more.
Great, Vishal. Thank you, Vishal, for your thoughtful insights. It has been a pleasure to have you on our Wealth Insights podcast.
It's been my pleasure, Vinay. Thank you for having me.
Thank you, viewers, for tuning in. This brings an end to the season 1 of our Wealth Insight podcast. Remember, wealth creation isn't about speed. It's about patience, perseverance, and perspective. All the best for your wealth creation journey.